Hello guys, you're welcome to this platform. Alright, this is still financial accounting. So the topic we have before us is bad debts and provision for bad debts. We want to look at how bad debts and for bad debts will affect the income statement and the statement of financial position. As you can see, we have here as our topic bad debts and provision for bad debt. The first thing we need to know, what is bad debt? Alright, bad debt is to be an irrecoverable amount or irrecoverable debts that a business organization has to forego, alright, because of some reasons. What are the reasons for having irrecoverable debts? It could be as a result of bankruptcy. It could be as a result of bankruptcy of a debtor. Alright, a business organization may not know the whereabouts of its debtor again. Alright, and some other factors. So the debt becomes bad. So if the debt that turns bad is being a debtor just showed up and decided to pay for a debt that has been written off as bad, it becomes bad debt recovered. So bad debt is seen to be expenses to a business organization, because once it is written off, once bad debt is written off, it becomes an expense. While when the debt that has been written off and that's bad, the debtor showed up someday somehow and make payments on such a debt owed, it becomes a bad debt recovered. In this case, bad debt recovered is what is an income to a business organization. You must have been hearing this word, doubtful debt. Doubtful debts. Doubtful debts are debts that the chances of payments are not certain. A business organization's debt in which the chances of payments are not certain. If a customer is owing a business organization and the chances of collecting that money is not certain, such debt is said to be what? A doubtful debt. And at a particular time, if the chances of payment turns to be negative, it becomes what? A bad debt. If the chance of payment becomes positive, it becomes a bad debt recovered. Now, we have what we call provision. Provision for bad debts. Provision for bad debts can also be called allowance of bad debts. Allowance of bad debts. Alright? Now, provision for bad debt is an amount set aside from the amount receivables, which you know, when we say amount receivable, we are talking about your debtors. So an amount set aside from the amount receivable or account receivable or from your total debtors balance so as to meet up future bad debt that cannot be predetermined. So if an amount is set aside to meet future bad debts that you cannot predetermine, in that case, you are making an amount, you are setting aside a particular sum of money to meet future bad debts that you don't know how much it will be. In that case, said to be provision for bad debt. Anything provision is said to be what? A liability. That's why the account for provision for bad debt has what? A credit balance. Now, with this short explanation, we know what a bad debt is. We know reason why we have bad debt. We know what we call provision for bad debts. And we also know what we call doubtful debt. Now, let's answer this short question. We are told that Egunje Enterprises has the following data relating to its account receivables, alright, as at 31st December 2015. Okay, account receivable as per trial balance, that means this is the debtors balance, 45. Bad debt written up during the year is 1,500. Allowance for doubtful debt is at 3%. Okay, this is the provision for bad debt. Then we are required to prepare the relevant account and extract a statement of financial position. Alright, Just 1 minute so we could solve that question. Okay, now in solving this question, I need to wipe off the board. The account, the owner of the account is Egunje. We'll write the name. Egunje Enterprise. Okay, so the relevant books of accounts are, the first one is account receivable. Account receivable. Like this, like that. This is the debit side, this is the credit side. Then I open my bad debt account. Bad debt account, like this, like that. Then the other account to be opened is allowance for doubtful debts. Debit, credit. Alright, now as you can see, your amount account receivable is like your debtors, account. It has a debit balance because your account receivable is your debtor, it's an asset. So I have balance brought forward. The amount is 45,000. 45,000. Okay, this is clear. This is the debtors. The amount is debited because all assets are debited. Now we have the bad debt written off during the year. Now this total debt is 45,000. Bad debt, the amount is, and bad debt is an irrecoverable amount. So the value is 15. Let's remove it from the total debt we have, so we know the amount remaining. So here we put it to bad debt account. Alright, this bad debt account, we remove 15. Alright, when we remove 15 from here, so for every credit there will be a corresponding debit entry. So we have debtors, our accounts receivable. Okay, it is 1,500. For every credit debit there will be a corresponding debit. So here we have the balance carried down to be 43,500. So we can balance this account for the 5,000. We can balance this account for the 5,000. So we have our balance brought down to be 43,500. Now that we have it like this, okay, this money here cannot be here alone. So it has to go to our P or L account. So we say P, profits or loss account. We have to transfer it. For every credit there will be a corresponding debit. So this amount is close to profit or loss account. So that's why you see that bad debt appears on the expenses side. Now for provision for bad debt. Provision for bad debt is a liability, and all liabilities are credited. Now look at what the question says. Allowance for doubtful debt is at 3%. Now that we have removed the debtors, the balance is 43,000. So we are going to say that 3 over 100 multiplied by 43,500. We are going to get the allowance for bad debt. Let's do that calculation quickly. And doing that quickly, we have this 3% of 43,500. We have 1,305. Okay, so what are we going to have here? What we're going to have here is going to be our profit or loss account. Okay, because it's going to, from here we'll post it to our profit or loss account. We have 1,305. This is the amount that will be in our income statement. All right, so we are going to have balance carry down 1305. Then we have balance brought down. So we have 1305. Now the question says, prepare the relevant account, which we have done. 1, 2, 3. Okay? Then extract a statement of financial position. Alright, let's show a statement of financial position. Statement of financial position. How will it be? Don't forget, we don't have non-current assets. We don't have anything. So my current asset now, current assets, I have my accounts receivable. Don't forget, this is my balance now. I have 43,500. Then I less provision or allowance for doubtful debts. So if I deduct allowance of doubtful debt, which is 1305, so what I have will be this. 43,500 minus 1305. So I have 42,195. So this is what will be my statement of financial position as my accounts receivable balance. Now, what if we are told to show it in our income statement? How would it be in our income statement if we are told income statement, income statement, income statement? All right, income statement for the year ended. How will it look? There's my sales, less my cost of sales. I have gross profits, then less expenses. Definitely to be my expenses. Alright, look at here. Alright, my bad debt is being transferred. So I have my bad debt. Bad debt 1.5 will appear. Then don't forget my provision too will appear. Provision for bad debt. My allowance of. Allowance for doubtful debt will be 1,305. So with this, I've shown how it will appear in my profits in my income statement. So with this, you should have no problem in adjusting for bad debts and provision bad debts in your final accounts. Thank you and God bless.